Hi, Mike Almala, recovering CPA, back with this next lesson in a mercifully brief introduction to financial accounting. A business that provides goods or services before it collects cash recognizes accounts receivable. Some businesses are in the fortunate position to be able to demand cash payments in advance of providing goods or services. For example, building lessors typically require a month's rent in advance, and insurance companies collect cash premiums covering a year in advance. In accrual accounting, a business receiving payments in advance incurs a liability called deferred revenue at the time of cash collection. This liability is an obligation to provide the goods or services that are already paid for. The obligation is discharged and revenue recognizes only after the business delivers the goods or services. If a business pays for goods or services before they are actually delivered, an asset called prepaid expense is recorded when payment is made. An actual expense is recognized and recorded only after the goods or services are utilized. Here's an example. Recall Joint Ventures had to pay Hertz Plane Rental $9,000 in December in advance for a 3-month plane lease. If a cash basis of accounting is used, all $9,000 is recognized as a December expense. Using an accrual basis of accounting better reflects economic reality because only $3,000 will be recognized as a December expense. The other $6,000 will be recognized as expenses in January or February of the following year. When Joint Ventures pays Hertz $9,000 on December 1st, the transaction is recorded like this. An asset, prepaid expense, is increased, and another asset, cash in bank, is decreased. Now, assuming Hertz Plane Rental utilizes an accrual basis of accounting, they record a liability when they receive Joint Ventures payment. On their books, the transaction looks like this. A liability is recognized by Hertz because as of December 1st, it still has to deliver 3 months' worth of plane use to Joint Ventures. The key point is that Hertz does not recognize revenue, nor does Joint Ventures recognize expenses at the time cash changes hands. Only after an actual service is utilized is revenue and expense recognized. So when does this happen? In this situation, the service in question is the leasing of a plane. At the end of December, Joint Ventures will have had 1 month's use of the plane. So at the end of December, the following entry on Joint Ventures books is made to reflect the rental expense for that month. Notice that the rental expense account for the month would have a $3,000 debit balance and the prepaid expense account would have a $6,000 balance. In January and February of the following year, similar entries have to be made to properly reflect the correct plane rental expense for these months. At the end of December, the following entry is made on Hertz's books. Again, similar entries will be made at the end of January and February. Now, deferred revenue and prepaid expense accounting can create opportunities for management mischief. A manager can overstate income and understate liabilities by treating deferred revenue as earned revenue. Essentially, this shady practice seeks to recognize revenue before it's actually earned. Such mischief often is not easy to detect because it is not always clear when the earning process is complete. A manager can also understate current year's expenses by claiming they are prepaid expenses. This amounts to a fraudulent claim that payments for a certain service benefit future accounting periods when in fact they do not. Not too many years ago, a large telecommunications company incurred significant cash expenses on maintenance of its utility lines. It fraudulently classified most of the outlays as prepaid expense rather than current period expense. Since prepaid expenses are recorded as an asset rather than an expense, expenses were understated and hence profits were overstated. So click here for the next lesson.